All right. Well, thank you everyone for attending this month's market update webinar for March 2024. We'll start as always with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated are not guaranteed, please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures, and throughout the webinar, please feel free to use the Q&A button to ask any questions you may have, and I'll address them at the end. Just a quick bio about me. My name is Jeremy Eppley. I'm a certified financial planner, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's degree in personal financial planning. You can connect with me on LinkedIn. And Silverstone Financial, the company, is a fee-only fiduciary registered investment advisory firm. We provide comprehensive wealth management solutions, including financial planning, investment management, tax prep, estate planning, etc. You can learn more about us on our website. So we can hop right into some of the notable events that happened in the past month. It definitely was an eventful month, a quite good month for the markets. The big flashy one that a lot of people have been talking about, of course, is the Bitcoin hitting an all-time high. It comes on March 5th. It hit $68,900 per Bitcoin, and it's only been a little bit over a month since the spot Bitcoin ETFs were approved on January 10th. So when you go back to, I had discussed it back in the day when we were talking about the bull case for Bitcoin and why I wasn't necessarily recommending it for any specific person, but in general, I was bullish on Bitcoin because of this pent-up institutional demand, where when these spot Bitcoin ETFs would be approved, they would have to go out and actually buy the Bitcoin to hold in their exchange-traded funds. And I had done, basic math of comparing it to some of the other large commodity exchange-traded funds like GLD or IAU, which are gold exchange-traded funds. And I thought, well, even if there's a small, a half or a quarter or an eighth of what those assets hold put into Bitcoin, it would be a large influx of cash into the Bitcoin network and cryptocurrency in general. And I was saying, until a spot Bitcoin ETF gets approved, and I thought that it would happen at least eventually, Bitcoin would likely go up in value over the long term. And so far, I've been correct. But now it starts making me think about when do people stop caring about Bitcoin? It's always possible that there's no actual intrinsic value to Bitcoin. You can't do anything. You can't build a building with it. You have to exchange it. It can store value, fluctuating value, but other than that, it's not like gold. At the very least, there's arguments to be had about intrinsic value and usefulness of gold. But you can at least make circuit boards out of gold versus Bitcoin. Now that the institutional demand is starting to be unleashed, I don't know how long that'll last. But now that it has, the spring has sprung, I don't know how long or how certain the bull case for Bitcoin is. So currently, I'm not saying it's a buy or a sell or I'm bullish or bearish. I am just honestly confused, not necessarily confused, but considering or thinking about it. Because Bitcoin could go either way now. Until that spot Bitcoin ETF was approved, I was pretty certain, or I had strong convictions at least, that Bitcoin would go up. Now I think I'm much more neutral, and I will likely continue having some of my client assets or recommending to have a small portion, under 3% of a portfolio in possible Bitcoin exposure, but we'll see. We'll see if it continues. I definitely had a great month this month, and I was happy, and my clients were happy that they had some exposure. I don't know how long that'll stay that way, but at least for now, everyone's pretty happy with the performance. Another, big news for all-time highs, both the S&P 500 and the NASDAQ both hit all-time highs. So we're officially past the pandemic. We reached those highs that we had before the pandemic hit and have now officially surpassed them and left them behind in the rear view mirror. I don't know if we'll end up revisiting some of the lows in the future. It's always possible, but it's good, especially for those that care about finance and follow the markets. It's good to see the markets at all-time highs. There is getting some froth in the markets. I'll jump to the fourth one real quick about NVIDIA. There's a lot of debate about, there's a lot of euphoria in the markets. That's why everything's up. And I think NVIDIA is the poster child for that. Again, not saying it's a good or a bad thing, but NVIDIA, and these are ridiculous numbers to me, NVIDIA is up 84% year to date, which is year to date's 2 months. So in 2 months, it's been up 84%. And in real dollar amounts, that's over $1 trillion that it added to its market cap. It was a little bit under a trillion before. Now it's over 2 trillion. So over $1 trillion of increase in value in 2 months because of mostly the frenzy around AI. And since NVIDIA is the gasoline that AI has to run on, they produce computer chips, for those that don't know what NVIDIA does. It has a lot of potential in the future, and people want to invest in that kind of company. Now, it's not ridiculous that it had a great quarter last quarter that announced amazing results. There's a lot of not only hype around potential AI, but there's also investments by Google and Microsoft and all the large companies. They are buying NVIDIA's chips, which is why NVIDIA is doing so well. So it's not only frenzy or hype. There is actual numbers behind it that can justify some of it, but it's still the speed and the amount of money flowing into it makes me concerned about potential getting over your skis, over over excitement, euphoria, all the words that you can use to describe over purchasing in the markets. So it's possible we'll see slowdowns. Even if we don't see slowdowns, there's more risk associated in the markets currently because of the frenzy. I'll also mention, specific for NVIDIA, I still feel worried personally about investing in NVIDIA because of the China-Taiwan risk. China repeatedly over decades have said that they're going to invade Taiwan. They haven't done it yet. There's debates if they ever will, but they've stated that they will. And Taiwan is where NVIDIA manufactures all of their chips. So if there is a war ever to occur, this $2 trillion company that makes billions and billions and billions of dollars a year would, at least temporarily, drop by 90% more because it can't produce chips if the one place it produces chips is in a war zone. So there's that kind of risk that I always like to bring up, that it's not in your control. If they ever wanted to, they could start a war, and NVIDIA's 84% that happened in 2 months could disappear in the next 2 months. I'm not saying it will, but be wary about over-investing in any single stock, because it is possible for that stock to vanish if something terrible happens. So diversification, I always like to bring it up. Diversification, index investing, passive investing, good proponent for that. It's always a good idea to try to think of things rationally and not get over excited about any one company or any one story in the market. Going back to number 3 that I skipped over for a second was the inflation read. All this good month, a lot of hype, a lot of increase in the markets came after the inflation announcement that came out saying that it was a little bit hotter than expected. It came out as 3.1 versus 2.9 as the consensus expectation. You can see a little graph to the side how it's definitely ameliorated over the last 12 months. So we're going to see how inflation continues to temper and if it is going to continue to act the way that the Federal Reserve wants it to act. But we'll see. Because of the hot inflation read, now there's expectations of fewer rate cuts, or at least later rate cuts for the Federal Reserve, which leads to less justification for the euphoria in the markets. If there were rate cuts, there's more justification for that to happen. Wanted to then discuss Amazon's going to be joining the Dow Jones Industrial Average. It's going to be taking over Walgreens' spot. So Walgreens is out, Amazon is in. I don't have much to say about it. I don't particularly like the Dow Jones Industrial Average as an index to follow. It doesn't make that much sense. It's kind of a mismatch of various companies. How it's priced and tracked is, I won't get into the details of it, but it's a little antiquated. It was created a very long time ago before some of the stronger methods for creating these indexes. But still, it was a big news item, so I wanted to mention it. Now, the final news item that is probably the biggest one, or at least the most exciting for me, the one I thought about the most this month, was Capital One announced that it is going to buy, well, technically is a merger between itself and Discover Bank or Discover Financial in a $35.3 billion all stock deal. So right now, Capital One is the fourth largest company in the US for credit cards, and Discover Financial is the sixth largest. I believe combined, it makes them number 2 or number 3. Overall, I'm excited about it. I am customers of both companies. I admire and like both companies and their services. And to dig a little into it, I think it's intriguing to see how that would shape or mix up the landscape. Now, there's always the chance that it won't be approved under, worries of monopoly or that kind of uncompetitive behavior. There's always the potential that'll be blocked. Currently, Discover and Capital One, they say they expect approval in late 2024, late this year, or early next year. But you can see it both ways. One is you're combining the fourth and the sixth to make a very, very, very large company, which is anti-competitive. But on the other hand, Visa and MasterCard in many ways are a duopoly. And the other two payments networks, which is American Express and Discover, have been a distant third and fourth place from Visa and MasterCard. And combining this fourth and sixth largest company, you would get a company that could actually rival Visa and MasterCard. If you think about it, Capital One currently is, of course, the fourth largest, and they have a ton of outstanding credit cards, and they issue Visa and MasterCard credit cards. Well, if they merge with Discover, I would expect over the next 10 years that they switch almost all their cards from Visa and MasterCard to their own network, the Discover network. And of course, that would hurt Visa and MasterCard because taking millions and millions of credit cards off their network would hurt their bottom line. But also, you would have this large company that's actually utilizing this network. Currently, the Discover network is used for basically a single card, just the Discover card. Versus like American Express, which is another third-party network, it has American Express cards and a few branded cards in partnerships. Discover doesn't really do that. It's just its own network, its own card. Here with Capital One, it would be its own network and lots of cards and lots of connections and lots of partnerships. And it'd be interesting to see that Discover network actually compete with Visa and MasterCard. So I'm torn between if it's competitive or anti-competitive. You could argue both ways. But personally, I'm for it. I want to see what this would turn out for the industry. It'd be interesting to see how it shakes up credit cards. But we'll see. I'll let you know if it gets canceled or blocked by the DOJ or anything like that. I'll let you know. Just I'll skip over this slide really quickly. The Federal Reserve, we usually talk about the expectations. There's no change from last month, since last meeting was in January and the next meeting will be March 20th. So nothing has really happened other than that the inflation read was a little bit hotter than expected. And now there's expectation that cuts will be either in lesser amounts or later, either this year or next year. So because of that, the Federal Reserve expectations have gotten tighter or worse, depending on your opinions. But there's nothing new officially from the Federal Reserve. It's just expectations from analysts and economists and such. So here's a heat map for those that have never seen this before. It's how I look at the markets. It's broken up in the 11 sectors, technology, communication services, healthcare, energy, real estate, etc. The larger the box, the larger the company. The greener the box, the higher the return for this period. The redder the box, the worse the return for the period. On the side, on the right, you'll see different indices and how they performed over the month of February. Dow Jones was up 2%, S&P 500 up 5%. The mega caps, so the Nvidias and the Googles and the Apples and the Microsofts and the Amazons of the world. So the top 50 largest companies in the S&P 500, they returned better than the overall S&P 500. They returned 6.2%. Small caps outperformed the Dow Jones, but underperformed the S&P 500 at around 3%. The global ex-US, so non-US company equities or company stocks, that returned 2.3% as normal. It performs worse than the US, but it's still positive. Aggregate bonds slightly down, down 1%. Gold pretty much flat, down 0.5%. Crude oil is pretty volatile, so up 3% is kind of flat for it. So not much change for oil. And of course, the largest number is that 45% return in Bitcoin in the past month. That rivals that Nvidia having 80% return in the past 2 months. This month it was just 26. So Bitcoin beat Nvidia for the month, but Nvidia has beaten Bitcoin a year to date for the past 2 months. We'll hop over to year-to-date view. Like I said, Nvidia closer to 80 and Bitcoin up only 47. And since it's only been 2 months, the year-to-date isn't very different between the two. I always like to show this graph. The outer ring shows the average return for the month over the past 70 years since 1950. And I like to show this because it shows some seasonality, some cyclicality from month to month in the stock market. What was interesting about February is it was the best February in 9 years since 2015. So on average, February is not a great month. It's a coin flip. It usually returns flat. So half the time it's up and half the time it's down. Here we had a really up February, up 5.2%. So a lot of, again, some argument that there's frenzy, some argument that it might be getting over its skis, but it's always nice to see some solid returns in the markets. The coming 2 months, March and April, usually pretty good months. Now we've seen abnormally good January and February's, so it's possible that we'll revert to the mean a little bit and give up some of the gains that we got. But historically speaking, March and April should be pretty good months. That brings me to the last slide. Usually I show this, just a basic, it's called a candle chart for the S&P 500. And I drew two very simple lines, not analysis, but showing this range, how it's been very straight all the way up with not that much fluctuation. And the fluctuation has gotten tighter and tighter. When that happens, usually means that it's going to either break out up or down. You can't say with certainty in either direction. It could also continue to consolidate for another month or two. I'm not going to make any guarantees or any calls for one way or the other, but I'll say historically, April, March are pretty good. However, the past 2 months have been abnormally good. So we could see it keep going up. We could also see a little bit of reversion to the mean, meaning it would be giving up some of the returns. Currently, I don't see anything that is flashing at me to that it could be a problem. We saw in the news New York Community Bank having problems, but I don't think it's indicative of the rest of the markets. It's just a single bank. So we'll see. I expect it'll continue to run higher unless some sort of black swan event, which means an unexpected event, shakes the market and causes some fear. If nothing happens, we could probably keep expecting it to go up. The only, I guess, one of the black swan events that could happen is, depending on what Jerome Powell says on March 20th during the Federal Reserve meeting, it's possible that he would say something that causes some fear in the market. But inversely, you could say something that the market really likes and it could go up. So again, it's hard to predict the market, it's hard to time the market, and the recommendation is stick with it, dollar cost average, passive invest, don't try to time the market. And over the long period, on the long term, you perform well as long as you stick it out and you don't act rashly or emotionally. If anyone has personal questions, feel free to email me directly. I didn't see any Q&As come in this month. We were a little light on attendees this month, but for those that have missed it, I'll definitely send out an email. You can watch the archive on YouTube all this month and previous months if you want to go back and laugh at me for terrible things or incorrect things I said, or praise me for a call that could have been a coin flip either way. It's all on YouTube and it'll stay there. So thanks everyone for attending. Hopefully I see you next month. And yeah, again, if you have any questions, you can always email me. Happy to help you out. All right. Have a good night, everyone.